Good morning and welcome everyone to our conversation starter session where we'll be discussing how to build an investment strategy that can withstand market change. We have an amazing lineup of speakers today. Wesley Bester, our head of derivatives, Rufilwe Mabileta, our in-house wealth manager, and Carl Burgess, our seasoned portfolio manager. One thing we can all agree on is economic change is constant, and we need to be able to adapt and pivot in these turbulent times. My name is Dumile Chiumi, and I'll be your host for today. I'm the segment head for Nedbank Private Wealth, and I have over 16 years of experience within wealth management and the private banking industry. My expertise include business, market development, deal structuring, specialized lending, key account management, and financial coaching and mentorship. I enjoy building and motivating teams, as well as finding innovative approaches to strategic and operational initiatives whilst providing effective client-centric solutions. My personal ethos is to always go beyond the call of duty. I believe in holistic well-being, and some of my interests include technology, videography, and I quite enjoy the camaraderie of team sports. Ultimately, I'm trying to find out, just like you guys, the audience, how to make money work for me as opposed to working for money. The purpose of these conversation starter sessions is to give expression to just that, to engage you, our clients, in an informal environment in the virtual sense, where we can hold richer conversation following the main thought leadership webinar that was held on the 30th of March, which was titled Staying Connected to Your Goals in a Changing World, with Nedbank Chief Economist Nikki Weimer, and also featuring the independent political and economic analyst JP Landman. Just some housekeeping rules for today's session. Please use the Q&A chat box on the left-hand side of your screen to submit a question during the webinar. If your screen freezes during the webinar, please press the refresh button and we'll take you back to where you stopped last in the webinar. You will receive an email in the next few days with a link to the recording of the conversation starter in case you'd like to share it or rewatch it, because there should be some gold nuggets for you to hold on to in it as well. Please remember, you can get more thought leadership insights from us, the savants, the recordings of previous webinars, and find out about future webinars on the Nedbank Private Wealth Essays page. Just to note, at Nedbank Private Wealth and Nedbank Financial Planning, we use our globally integrated and advice-led approach to connect our financial decisions to our goals and aspirations. Your money decisions connect your goals and needs, dreams and fears, attitudes, and the roles you play in your community to how you earn, save, and spend. This is what we call connected wealth. The fact that every financial decision you make is informed by and affects every aspect of your life. Your globally integrated advice makes these threads more visible and therefore more manageable. It also connects you to solutions, service, and expertise that you need to make the most of your money and achieve the definition of success. I referred earlier to the fact that I love teamwork and I love the camaraderie of working with teams. And today I have just that, expert teammates that are going to help me decide how to express the message, how to be resilient in terms of the global changes. Firstly, we have Wesley, our Johannesburg stockbroking branch manager, who has built an extensive wealth management network across both the retail and institutional investing space. He has over 17 years experience in stockbroking industry with a passion for finding the right solution for clients and giving them the best experience while doing so. He previously ran the derivatives trade desk, where he learned to thrive under stressful situations, often needing to instantly weigh off risk versus rewards on deals and executions. He enjoys staying fit and studying, believing the mental and physical wellness is a must in terms of the balance of life. The rose amongst the thorns, Rufilwe, is an investment professional who has over 13 years worth of experience in the financial industry, where she's gained vast experience in insurance and asset management. She's passionate about financial literacy and bridging the gap in the access to financial advice. She helps clients reach their financial security goals during their retirement years, and she participated in Nedbank Private Wealth's Retire Right webinar in 2022, where she addressed proposed regulatory changes and the impact of a prevailing market condition on retirement plans. Last but not least, our graduate with a BCom honors degree in financial economics and investment management, Kyle, has spent 2 years trading and managing money in the financial markets. In the early part of his career, he traded various derivative instruments before moving into portfolio management in Johannesburg, where he's been managing money for individuals and institutions for the good part of the decade. In his role as our portfolio manager, he forms part of Nedbank Private Wealth's investment team and assists clients in achieving their long-term financial goals through quality companies that are actively managed to a rigorous and value-driven process based on our in-house view. I, like you, the audience, would like to find out how they can help us understand resilient investment strategies. So, turning to Refilwe, curiosity bites. Refilwe, what is the difference between timing the market and time in the market? Please could you let us know?
Thank you for that question, Dumi. Let's start with timing the market. So people tend to, after a big market sell-off, try to sell out of the market, park the money in cash with the hope of re-entering the market at a later stage when it's safer to do so. Now, I have to just let our audience know that this strategy is not very effective at all because no one has perfect foresight. So in other words, it's the same as trying to predict the weather. A far more sensible approach is actually spending time in the market. And what do I mean by that? So in essence, it's allowing investments to give you the types of returns that will actually meet your objectives in the long term. Another thing, though, to bear in mind with time is inflation. So inflation is something that actually erodes the purchasing power of your money. So whilst time does work for you in your favor in the long term, because you get to benefit from compound interest, it's very important to make sure that the investments that you invested in are going to generate the types of returns that are, at a very minimum, going to compensate you for inflation. But in essence, the key takeaway from there is to say, rather find an appropriate strategy with you, consult a professional, and then stick with the strategy through volatile times in the market. Back to you, Dumi.
Well, speaking about consulting a professional, I'm going to have to check in with my optometrist because my glasses were supposed to give me foresight, and clearly that's not going to happen here. So let me ask you this then. How can I turn a market correction into an opportunity, Refilwe?
So market corrections, we know, are a very stressful time for clients, and we understand that. But it's very important to remember that these are a very normal part of the cycle. So rather look to them as an opportunity to buy good quality assets at a discount. So there's a lot of research out there, long-term data, that actually points to the fact that diversification is actually the best risk reduction tool that we have at our disposal. So again, speak to a professional and make sure that you've got a well-diversified portfolio. And by that, I mean you must be invested across various asset classes, various geographies. So in other words, both developed markets as well as emerging markets. And that is how you will better weather the storm when there is market volatility. Back to you, Dumi.
Well, then, please give me some insights into the value of advice as you referred to speaking to a professional during times of such high market volatility. What intrinsic value would I derive from speaking to a professional? What's the value of advice?
Sure. So a professional or an advisor, or in my case, a wealth manager, will help you stay the course. So in other words, they will help you make the types of financial decisions that will withstand tough times. In other words, if you've got a financial plan where you are contributing monthly towards retirement, having an advisor helps you because that person will help you stay invested. They'll help you also stick to the plan. So it's the benefit of both having somebody basically stop you and save you from yourself because you're not going to make emotional decisions. But it's a person who also guides you in terms of coming up and crafting an investment plan that's right for you. Make sure that your investments are invested, as I said, well diversified across the globe. So it's basically just having somebody to walk the journey with you so that you don't end up being reactionary and making decisions that will cost you in the long term. And another benefit, before I just end off, Dumi, is that an advisor also can give you solutions that will also provide you with some downside protection during times of high market volatility. And this is something that obviously my colleagues will expand on a little bit more detail later on. Thanks, Dumi.
Okay, so Refilwe, I'm sold. I'm giving you my assets. I'm happy with that. You've convinced me. I'm going to get value. You're going to make sure that I don't make decisions that are novice. But now I'd like to understand practically. My money's with you, and we're in this volatile environment that you've just given reference to. So your portfolio manager, I understand, looks after my money, and I'd like to understand, Kyle, how do we manage risk in client portfolios in volatile environments then?
Morning, Jimmy. Good morning, everyone. It's good to be with you here this morning. So it's a great question, I think, particularly in the volatile times that we've seen over the last couple of years. So, I mean, as investors, we essentially are deploying capital on behalf of our clients. So first and foremost on our minds is capital preservation, and part of that is risk management. So we typically have three levers that we can pull from a risk management perspective. So the first one being our forecasted earnings, and this essentially involves potentially pulling back the earnings that we may expect a business to generate over a sort of 3-year period. So the impact that this has is that it would ultimately decrease our expected return on that specific business and make it a less attractive option to hold in the portfolio. But the point is that we factored in a pullback in earnings given a potentially poor outcome, whether that's from the economy or it's a company-specific risk. So the second lever that we then have to pull is essentially the ratings that we would apply to a specific business. So once we've got the forecasted earnings sort of mapped out over a 3-year period, there's a significant amount of work that goes into ultimately producing these numbers. We then apply a discount or a premium for a specific company relative to the market. So as an example, a business that is 100% exposed to South Africa would trade at a lower premium or lower discount to the market relative to something like a Richemont, which is sort of a globally diversified business. So that's another lever that we can pull. And then finally, we can use position sizing to manage risk. So what we try and do is find a balance between having positions that are meaningful in portfolio. So whether that's sort of 2.5%, 3% of the portfolio, right the way up to about 5% of the portfolio. If there's really a positive outcome, then that position can be a meaningful contributor to the performance of the overall portfolio. But also, if we get it wrong, that you are limiting your downside. So in our world, a position size of 5% would be regarded as fairly significant, and you can either sort of downsize that sort of position or the position that you're holding, or exit the position entirely. So that's sort of how we view sort of risk management at a portfolio level, and I hope that that goes some way to answering the question, Jimmy.
Thank you for those insights, Kyle. But I have some smart friends, and I was speaking to them about derivatives the other day. So I'd like to delve deeper into this economic volatility and speak to our head of derivatives and ask him. I've heard that they're way too risky to be included in a portfolio, especially in such an environment. And I'd like Wesley to give me some insight into his views around this. Can they actually be beneficial over a long period of time, Wesley?
Thanks, Dumi. No pressure there. Welcome to our colleagues and our clients online. Happy to be here to share some insights. I think firstly, I think it's crucial I start with the disclaimer that, yes, derivative products are risky and clients can lose money, but if managed correctly, they're an asset class that can't be ignored. They provide an ideal investment solution to any investor. So I'm not too sure what the experience of the audience is like. So I think it's crucial that I give you my one-liner on what derivatives are. And, they're a financial product. They're based on an underlying asset, which is either a stock, a commodity, currency, a bond. And they move in parallel with your underlying asset price. So your gains and losses are settled on a daily basis against your free cash. And this just helps you, assess where you are on a daily basis and helps you manage your risk. Back to the question, volatility, yes, it does present opportunities for traders and investors. And, if it were not for these volatility spikes, we'd not be getting these buying and selling opportunities in the market. So basically, every stock does hold a certain intrinsic value at a certain point in time. And these price fluctuations above or below these price movements this is what we try and capitalize on. So, by making use of derivative products, we can participate in upside and downside moves at a fraction of the cost with a minimal capital outlay compared to your normal vanilla long only side investing. We are seeing clients investing and allocating a portion of their portfolios to derivatives. And I think this is just to help them drive above inflation returns. Obviously with higher risk means higher potential returns, and derivatives are risky, but there are most certainly benefits involved if they're used correctly. So again, don't overexpose yourself, have your parameters in place. I'm a stickler for stop losses, have them in place, and always measure your risks and rewards. Again, I think it's essential that you know what products you're dealing with, that you're getting involved in. And we do have experts in-house at your various stockbroking branches. Please be in touch with them. They're happy to assist. Back to you, Dumi.
Thank you, Wes. Well, I blacked out for a second. I had a swig of my morning coffee, so I'm wide awake and I'm alert for risks. And given that you've mentioned exactly that, I need to understand from our portfolio manager again then how we actually monitor for SA specific risks, because a lot's happening in the local market currently.
Yeah, there certainly is. So earlier I mentioned, one of the levers for risk management was being able to change the ratings which were applied to a specific business. So we also have something similar which we apply to SA as a country. So we watch a number of KPIs that we monitor. So these risks are essentially monitored on a robot type system, so red, amber, or green, depending on the direction of travel of all of these factors. And this would then influence the ultimate rating that we would come up with. So what this would look like at the end of the exercise, you'd have 3 different scenarios, which we would envision. So either a low road scenario, and in that sort of specific scenario, you're looking at sort of a pretty poor outcome from SA Inc. So you probably want to avoid businesses that have 100% SA exposure. And there are obvious caveats to this. I don't think that it's a one-size-fits-all solution, but it's a general screen that we use to look at portfolios. What we would be looking at is businesses that are globally diversified, so strong management teams that have a strong track record of capital allocation. So businesses that come to mind would be Anheuser-Busch, Richemont, and British American Tobacco. So you can kind of see where we're going with those types of businesses. We then sort of have the muddle through or middle of the road scenario, and we would be looking at businesses like Sanlam as an example. They have some sort of offshore diversification, but largely SA. Again, SA banks would probably fall into this category as well. So you can see high quality businesses, strong balance sheets, but some sort of diversification. And then the final category would be your SA high road. So this would be a scenario in which SA Inc. does particularly well. So perhaps upside surprises from electricity generation perspective, perhaps, or an upside surprise from a GDP perspective. And in this type of environment, you're going to hold businesses that have high SA Inc. exposure. Something like Mr. Price comes to mind. But that's broadly speaking, how we would manage that sort of SA specific risk on client portfolios. That's all from me. Jimmy, back to you.
Thank you, Kyle. Thank you very much. I've heard a lot of pestle factors being mentioned in your response there. And from a derivatives perspective, back to you, Wesley. I mean, we've seen considerable drop-offs in the market on the back of local and external factors. How do you propose we go about reducing some of these risks?
Thanks, Dumi. This is one of my favorite topics, so best you sit back and relax. I've got a lot to say. So let's start with, on our stockbroking accounts, we can hedge total market risk, we can diversify through commodities, we can eliminate your currency exposure, and we can eliminate and reduce your exposures to certain stocks. And I think it's crucial that we can do these for any period of time. So we can reduce your risks, for a few minutes over results, just as they're getting released, if you're worried about the results, or for a few years. So these are quite tailor-made. How do we, sorry about that. How do we handle these 2 different accounts? We have a separate account for your long-term portfolio, so don't mess with, so don't mess with any of Kyle's overall discretionary equity portfolios. And we have our separate execution only accounts for our clients where we handle derivatives and all other products that can be executed either by the client or themselves online. So I think it's essential that we complement your long-term portfolio, but in a separate account so we don't impact your holdings or affect your tax position. Back to the volatility, to the question of internal and external factors. They definitely do have impact on our local markets. So if we look at, the US bank failures that recently happened, you will see our banks getting impacted and, a bit of a sell-off happening on those. Local factors like load shedding, no, they definitely do have impacts on your currency and your bond markets. So we can hedge out against these. Just giving you some examples of what we've seen happening in our markets and on our desks. Clients are reducing risks in the current in the current market. I'll give you some brief examples. I do need to highlight that, it's not just about maximizing profits, but rather about protecting against potential losses. So some of the hedging strategies that we're seeing and that we're implementing on our desk is, diversification. I enjoy being market neutral sometimes, especially in these environments. So we long or short an index against your preferred stocks. We also simply hedge out against certain stocks that you're highly exposed to. The idea or the requirement is that you're looking for a zero-sum game. You're winning on your equity portfolio, or you lose or you're losing against on the hedge, or vice versa. And when the market's more stable, you just unwind the hedge quickly, and then you just continue to participate in moves higher in your normal portfolio. On the options side, we are reducing risks by purchasing some put options. We do also do structuring, such as collars. These are both listed as well as over the counter. I think it's a good time to draw your attention to some new structured notes that we're going to be releasing shortly. These are all capital guaranteed, 1 and 2 year terms. These can be rolled over, or they can be exited. We will have our stockbrokers in touch with you on these notes, just giving you some more guidance. Thirdly, we're seeing some futures and CFDs being implemented to increase or reduce long-term portfolio exposures to certain stocks. And then in the downside, when the markets are coming off, we are seeing futures and CFDs being implemented to gain from moves lower. Back to you, Jimmy.
Thank you, Wes. You mentioned currency volatility, which sparked a question in my mind for Kyle. Given that aspect and what we're facing in terms of the economy, what methods do we use to get offshore exposure through an SA-specific portfolio in light of a weaker rand?
Thanks, Jimmy. I think that's a great question. I think it's an area of our business that's often misunderstood. And I should probably end with this, but let me start by saying that while we hold a local equity portfolio, typically your underlying earnings from that portfolio are going to be somewhere between sort of 55% and 65% from outside the borders of South Africa. So whether that's through Brazil, through Anheuser-Busch, China, through Prosus, Naspers, or ultimately Tencent, the message is that you're not 100% reliant on SA businesses. So when we do see sort of the currency depreciating quite significantly, we'd like to benefit from, or you'd like to see the benefits of that coming through the underlying earnings and ultimately the share prices. And I'm not saying it always happens like that, but that's really the idea that we're looking for. I think what's important is in these situations is to keep a level head and ultimately bring it right back to valuation. So over the last 2 years or so, the JSE has outperformed the Nasdaq and the S&P 500. But the fact that developed markets don't always outperform emerging markets, and while it has perhaps done so for some time in the past, that relationship doesn't always hold true. So it's still important, not to get caught up in the narrative around, just taking money offshore, not worrying about valuations, not worrying about the exchange rate, and that, returns may be relatively easy to come by. And perhaps an easier way to think about this is that if you do expect the rand to sort of pull back in time, if it is trading at sort of relatively expensive levels, you'd want to be overweight SA banks at a time like that, which is, I'd say, probably where we are at current levels. So I hope that answers the question to me.
It does, and it whets my appetite a little more. Given the last response from Wes as well, he was giving expression to some of the instruments that we could look to use, such as structured notes. I'm curious. I'd like to get some alternative offshore exposure other than the normal listed equity. And I want to know, are there any other ways to gain exposure that are easy? Wes?
Thanks, Dumi. I think just to dovetail on Kyle's mention on the currencies, yes, currency futures, they're a great way to gain direct exposure. I'll just give you a quick synopsis before elaborating further on all of these points. There's no SARB approval required. There's no cross-border fees. They're settled and traded in ZAR. They're very cost effective. They are standardized and they're guaranteed by the exchange. So currency futures, I'll give you a quick rundown. They are standardized contracts. They allow you to buy or sell in a foreign currency such as USD, euros, GBP, and Aussie dollar. These are all backed against our rand, our local ZAR, and you can make use of these contracts for speculating, hedging, or diversifying your portfolio. These contracts are listed on the JSE, who guarantee your settlement. So in effect, there's zero default risk here. And these are extremely liquid. They provide great flexibility and efficiency in managing offshore investments. As Carl mentioned, especially when there's a timing aspect involved, when the rand is quite weak, we're happy to hedge out this risk for you. And and these run parallel to the spot currency exchange. They're traded between 9 to 5. Just some more details on these contracts. They're traded and settled in rand, so they don't require any SARB approval, or there's no cross-border transactions involved. There's about 15 times gearing in these contracts. They do require a small capital outlay, which we call margin, and as mentioned, very cost effective with your fees being less than 1 basis point. You should, however, formulate a clear strategy, stating having your risk tolerance and your time horizons in sight. Again, our team of professionals are happy to assist you with this if you need to do this. To sum up, currency futures can be a valuable tool for gaining offshore exposure beyond your traditional equity investments. They do provide great diversification. They can be used as a risk management tool and provide exceptional liquidity and transparency. I think, we do get posed the question, where's the currency going? What's happening? So just giving you a quick synopsis on that from our research team. Cyclically, we prefer to maintain a weakening bias in the face of our slower global growth. The US is going through a tightening monetary policy. So we're looking for the rand to move towards probably about 19 in the second quarter. But don't fear, we are looking for it to normalize back towards the 1760 level through the fourth quarter. And I think just for interest's sake, it's not all doom and gloom. We have got a long-term fair value on the rand, which is closer to 1650, but this is a longer-term view. I think just in closing on this question, the derivatives team does regularly put out our technical engagement pieces, as well as short-term trade ideas. And then from Carl's side, they do produce fundamental research where they formulate a synopsis on company results, as well as longer-term recommendations. And then just for clients on this call, we have got access to all these notes in our research center on the website, and we do email these out to clients that have clicked, that have asked to receive these. So I think it's a great resource that you should be using. And, it's just a great value add to our clients. Thanks, Dumi.
Thank you very much, Wes. I'm certain that there are questions from the audience. We've had a lot to digest and a lot of nuggets that I've picked up, which I will give expression to later. But let's go to the chat box and see what's there. So I actually have a very interesting question. I think it's something that's burning on the minds of everyone. And I'd like to pose this to Kyle. It says, when will these interest rate hikes stop? We moved from 8% prime to 11% in about 6 months. It's killing us. Definitely is. How can business grow with all these hikes?
Yeah, I think, as you mentioned, it is certainly on everyone's mind. I mean, we've already seen some significant rate hikes or significant increases this year, and consumers are certainly feeling it. So we would expect to see perhaps somewhere between 25 and 50 basis point increases through the end of this year, and then potentially the first rate cut coming in the first quarter of next year. But I think that there are some big sort of question marks around that. It's not it is a moving target, and it would largely be influenced by sort of big currency moves and any further developments in load shedding. So I think in summary, still probably quite a difficult end to the year, but potentially some relief for consumers towards the beginning or the first quarter of next year.
Well, as said, it's not all doom and gloom. Wes said that. So we remain optimistic as South Africans and resilient too, though it's very hard to do this with this candle that's keeping the lights on now and then. To Wes, though, there's another question here on short-term trades. It says, what short-term trade specifically is the desk currently running, the derivatives desk?
Thanks, Jimmy. As mentioned, we do publish short-term trade ideas as well as great engagement pieces. that are, both of short-term and medium-term nature. I'm actually just logging onto the website now, so I can pull off one idea that we've just released. We've released a trading idea on the JSE actual stock. So the short ticker code is JSE. So we've posted this on the website in the research center, as well as emailing it out to those clients that have clicked to get this via mail. So how we've positioned it is that we're buying the JSE with the entry range on the stock between 96 and 100 Rand. So we will be buying the stock anywhere between 100 Rand and 96 Rand. We do always indicate, what your stop loss should be. So our stop loss for this trade is a close below 90 Rand on the stock. And we have got a profit target of 115 Rand. I think just to note, we have actually put these trade ideas, this specific trade idea on before. JSE's been trading nicely in a range between 100 Rand and 120 Rand quite consistently. So that's why we're putting this trade idea on that lower entry range, closer to 100. And again, as I said earlier, I'm a big stickler for keeping to your stop losses. So our stop loss is 90 Rand. Again, our trade ideas do come out with a whole strategy section, as well as our technical backing on each of these ideas, and it's actually laid out quite nicely. We've got a timeline on all these ideas, so we've stretched this timeline out a little bit longer. So we're keeping it running till August. We do normally do a shorter time frame, generally about a month, on these trade ideas. We've just kept it a bit longer because the JSE is a bit of a slower mover, and and they've got results coming out around about August, so we've kept it for that. And, so clients can, should they run this trade, they're looking for some potential returns of just north of 16% from current levels. It's currently trading around 97 Rand this morning. So it's pretty good levels for our entry stage. Yeah. Thanks, Dumi.
Thanks, Wes. And sticking with derivatives, more specific, I think we've piqued some interest. Where do we find details of the derivative products? Are they available on the website? If you can give some insight into that, and then I'm sure we will also give a specific link to where all this is as well.
Thanks, Jimmy. Yes, no, definitely. They're on the website. We have got some great videos as well. We've got some great educational content, which is actually pre-login on our website. There's a little book on our website. Click on that, and then you can click on our educational videos. We have got some questions and answers there, frequently asked questions. And we've got some notes on which products we've got available, and the derivatives are definitely found in there. So yeah, hope that answers your question. And they're more than welcome to reach out to their various branches or, wealth managers, portfolio managers, and they'll guide their clients to us. And we can definitely set up some chats with the clients if they're interested.
Thank you, Wes. Thank you. I've got another question for you, Kyle. Is with the Chinese buying our resources, is this a good time to be buying resources?
Thanks, Jimmy. Yeah, I think this is the question that we often get with the volatility that we've seen in commodity counters. But I think when looking at commodity counters, it's important to look at supply and demand, both sides of that picture, and understand that it's tempting to focus on the demand side, particularly when you've got someone like China, who is a very big buyer of oil and things like iron ore, just as an example. And thirdly, it's also important to look at valuation of those businesses or specific commodity counters. It obviously would include all the risks and opportunities that may come with them. So what we've tended to do in the past is focus on diversified commodity counters, perhaps something like Glencore, BHP, and Anglos. And we've tended to shy away from single commodity counters like the platinum and gold counters for multiple different reasons. But at the moment that we feel both Anglos and BHP are probably fairly valued, and would probably shy away from adding them to portfolios at current levels.
Thank you, Kyle. This is the last question, and this is directed at you, Refilwe. Given that you are keen on bridging the divide in terms of access to financial advice, the question specifically says, if you're new to this, like me, and have never grown up with these metrics, i.e. shares, etc., whom do we speak to?
I'm very, very happy about that question, because I was actually thinking that for people who are listening in, this might sound a little bit technical. So I'm quite happy to dial it back a bit. And basically, let's just look at the fundamentals. So there are principles you need to remember. Time means compounding. So that means getting growth on top of growth on top of growth. That is a principle that, whether it's Warren Buffett, it doesn't matter who it is, that is something that is undeniable. The best way to grow wealth over time consistently is time in the market. So in other words, for somebody who's a novice investor, start early. If it's never too late though. So if you're a child, if you're young, if you've just started working, obviously ideally you'll benefit the most from compounding over time. But even if you're in your 40s, it just doesn't matter. Start wherever you are, but then be disciplined in your approach. So that's why I said rather speak to an expert. It's very difficult to start out investing, and then when you do see that your portfolio the following month is down 30%, to not panic and sell out. As I mentioned earlier on, put the money in cash and hide in cash, which over time, unfortunately, is not likely to give you above inflation returns. So my suggestion would be to whoever it is, start wherever you are, but do consult with a professional. They will craft something that is bespoke for you, that is right for you, given your needs, given your investment profile. So in other words, what your risk tolerance is. Not everybody has, the stomach to watch a portfolio go up and down 50%, down 30%, but other people have the wealth already, so they don't necessarily mind taking on the risk. So it basically is dependent on your unique circumstances. So again, the key takeaways are start early, number one, and then be disciplined. So stick with the plan. Don't be tempted to sell out. And then obviously consult and speak to somebody who can then help you navigate, because you will go through changes in life. It can be divorce, it can be having children. You need somebody who can then help you make those tactical decisions in terms of, is this asset allocation still appropriate now that you're divorced, or now that you're starting a family, or now that your needs have changed. So it's very important at each stage to have those conversations. Another thing that we didn't touch on in today's conversation is estate planning, which is pretty much the foundation. So if you think of a house, think of estate planning as the foundation upon which you're supposed to basically structure and build your wealth. That conversation, again, an advisor can basically guide you through that in terms of, do you have a valid will that's in place? Do you perhaps need to make use of a trust? What happens in the event of death? Do you have sufficient liquidity in your estate? So these are the types of conversations that, unfortunately, as a novice investor, you, even with all the Googling in the world, all the YouTube videos in the world, you just won't be able to know, because nobody knows what they don't know. So rather do speak to a professional. They will ask you the relevant questions and they will walk the journey with you. Thanks, Jimmy.
Thank you, Refilwe, and thank you for bringing it back to a level where us laymen can understand and digest it in a palatable size. Well, the last, I think, more technical question that I'll pose to Kyle before I close and summarize is from the audience again, is how to grow capital in the context of a sharp devaluation of the ZAR, i.e. South Africa has a high level of dependence on imports. Did you hear that?
I did, thanks, Jimmy. So I think this question potentially links sort of quite closely to what we have spoken about previously. I think we're fortunate in South Africa where we've got great global businesses that happen to be listed on the JSE, and investors obviously have access to these businesses. And it's important to remember that the performance of this JSE has or is decoupled from the local economy for that very reason. So there is the potential to continue to earn excess returns on the local market, even while the economy is perhaps not doing as well as we'd like it to do. And I'm certainly not saying it's easy to produce excess returns, but opportunities for this, I think, do exist.
Thank you, Kyle. Well, if anything, I can say that the one thing that you guys all have in common are you are money experts that are intent on doing good. And I've been making mental notes of the things that you were saying. And I just want to share the key takeaways from each of you that I've picked up on. With respect to Refilwe, what I've understood is that we must avoid the temptation to try and time the market. Foresight isn't the thing that we have here. We need to be very, very informed in terms of what we're doing in terms of our research. Take a long-term view of the market and stay the course of achieving your long-term goals. So that means being focused, and speak to a professional about crafting an investment strategy that will weather market changes. Am I correct? Great. And with Kyle, what I've understood is that we have three levers which we can pull to manage risk, earnings, ratings, and position size. Don't get caught taking money offshore at all costs, and keep a level head to bring it back to valuations. And we can also benefit from a weaker rand on our investment portfolio. Is that right?
Perfect.
Great. And Wesley, I'm 2 for 2 here. Derivatives are risky, but they definitely have benefits that are involved if used correctly. So our clients can also benefit from that by making use of our experts. Secondly, derivatives can complement your long-term portfolio as they are housed in separate accounts without impacting long-term holding or your tax position. And then lastly, current futures are available tools for gaining offshore exposure while also being an excellent means of diversifying your asset classes. Do I get a thumbs up there too?
Well done, Dumi. You nailed it. Well done.
Thank you, Wes. Thank you so much. Well, in closing, I would just like to remind all at home that you will receive an email in the next few days with a link of this recording if you missed any of the gold nuggets that were shared from this conversation starter. The email address will be shared with you. And lastly, your views matter to us. So please help us to improve our future webinars by giving us your feedback in brief. On your screen, you will probably now be seeing the display of a QR code with a step-by-step guideline on how to access the survey. And lastly, thank you very much for joining us on this Monday, which we've turned from blue to bright, as we have optimism about where we're going in terms of the economy and our way of managing money and our global strategies that are resilient. Go well and stay safe, and let's avoid the turmoils of load shedding. Take care.